Is the real estate market crashing? Is it booming? Is it neutral? Well, it kind of just depends on where you look.
I know. Well, if you guys are trying to figure this out on the internet, you're probably as confused as everyone because depending on who you're listening to, you're seeing there's a lot of listings in some areas and prices are falling. And in other areas, it's booming and there's all kinds of deals. So we're going to dive in here in this segment right now because Danille, specifically Danille, did a lot of work on this over the weekend.
Well, we always say on this real estate channel, real estate's local. Like when you listen to certain YouTube people or you watch the news or you listen to a podcast, they want you to make it think it's national. They want you to think it's either all crashing, it's all booming, it's all what, and that's just not the case. It's more what's happening in your backyard. So you have to look at your area that you're looking to invest in or buy a home in to know what your market is doing.
But also, before we jump into that, I want to just talk about what everybody perceives as a crash. Like, if you guys could maybe send that in, let's take a look, because I think everybody's definition of what a crash is different.
Right.
So if you own an Airbnb and you don't have anybody renting it, you might think you're in a crash, but it might not be. That market might not be. It might just be Airbnb. If you're a lender and you're not getting paid, that could be your definition of a crash. So, what is yours, Danille?
I think that for my definition of a crash would be prices that are lowering very quickly. And we are actually seeing that in some areas of the country. And you almost have like people panicking and then listing their house in order to salvage any equity that they have.
Correct. That's actually what I would say too. So now, does that mean it's a crash? So in the commercial real estate, which is where I hang out mostly, we know that prices, specifically multifamily and office and all that, they went down 30% at least based on the cap rates that actually went up and the interest rates that actually went up and the cash flow that actually went down. So we know that, but doesn't necessarily mean it's a crash. They just repriced.
Well, right. That's what's interesting. If people are starting to see reductions, like even in the Arizona market, we're seeing a little bit of reductions in the last few months on prices. But what people have to remember is we're at the end of the year. Like we always see price reductions at the end of the year, right? Because, you have the holidays and people listing during this time usually urgently need to sell, whether it's because they already bought another home, they're going through a divorce, they're moving, like whatever it is, because it's not an ideal time to ever list your house. So people always are like real cognizant of this. And also just because prices are going down, prices have went up so much the last few years that of course, real estate's cyclical. So it's going to go down, but just because it even is going down 20% doesn't mean we're in a crash. What we saw in 2008 specifically, with the last time we had a crash, was that people were panic listing. People were like, oh my God, prices are dropping every single week. And if I don't list my home now, I'm going to lose all this equity. And there weren't that many buyers, which is key because, people couldn't qualify for mortgages. You had bad mortgages. People didn't have equity. So the whole system was like melting down. So that's like a very bad crash.
Yeah, I think that is a good definition of a crash. So if let's say your cost of food was really high and now it's come down, that doesn't mean it's crashed. If the cost of a car was up really high, and we know it was because of the supply chain issues, and then it came back down to earth, that's not a crash. All that means is that there's more cars to choose from, and the dealers are now having to negotiate a little bit with the consumer. So let's be cognizant of the word crash, because just because there's more listings being added doesn't necessarily mean it's a crash yet. However, there are markets that we're going to talk about today that are something we should be watching.
Yep, absolutely. And Jerry, can you pull up that bank rate, the key takeaways? So this is interesting because existing home sales actually in October rose 3.4% from the previous month and 2.9% from a year ago. So I thought this was kind of interesting because everyone's like, oh my God, the market's crashing, like home sales are slowing, it's going to be this crazy thing. But if you really look at it, we're up 2.9% from 1 year ago.
And the median price is up.
And the median price is up, right?
So those of you who are looking at national stats, you're laughing at people that say there's a crash.
Right, like a national crash,
yeah.
right?
And it might not be in your area.
Now, the one thing, though, is inventory is at now a 4.2 month supply, which...
It's normally around 6.
Right, so it's normally around 6. So but it's creeping up because it's been in the 3s, right? So the inventory is going up, which is good for buyers, right? Because that is why you're kind of seeing... buyers now having some bargaining power and sellers even having to discount a little bit from maybe an unrealistic number they were trying to get last year. But what's interesting, though, is, once again, people see, oh, my gosh, buyers are able to discount now. It's crashing because they can discount. Like, they always were able to discount. The anomaly is the last few years when buyers couldn't discount and they were waiving, inspections, and they were 7 offers on a house within a day. Like, all that was weird. This is like more normal. Buyers usually can negotiate.
Right. If prices are going up, I would go out on a limb here and say there's not necessarily a crash nationally. However, we have identified several markets that are in a very different scenario than these national figures. And I think that's the whole point Danille made in the beginning, is that this is not a national market we're talking about.
Right.
You have to look at things nationally, but you can get really skewed if you're hanging on this and you're not looking at some of the signs that are happening in other markets.
And Jerry, can you pull up the Zillow's Market Heat Index? Not that one. So right back. Yep.
Yeah.
So if you can look here, you can see kind of where we're in a buyer's market, right? The whole Southeast, a lot of those different areas are a buyer's market. And then you have places like New York City that's right now a strong seller market, you know, and then even, places like Phoenix, Denver, Dallas, it's kind of neutral. And that's kind of what we're seeing right now in Phoenix. It's sort of leaning towards buyers, but not really. It's pretty much a neutral market.
So stay on here for a minute, Jerry, all right? So take a look at the strong sellers markets, right? San Jose, New York, let's say, and other sellers markets. Those are important things to watch. Now, if those are strong and the blues are the buyer's market, then what you're going to see is you're going to see a blend. That's kind of the point. So this is a really good map to look at, because you're now seeing something very different between a strong seller and a strong buyer's market. And if you're looking at those together all in one, if you're looking at the whole U.S., you're going to see that things are not in a crash scenario. However, there are definitely markets where you're starting to see the buyers are actually starting to get better and better deals, and specifically Florida. And I know we're going to get to this, but that's actually what kind of puts things on our radar for us. Is we started to see, we have friends in Florida, we have viewers in Florida, we have people that are emailing us and DMing us about Florida, and so Danille's going to go into that more. But I think it's interesting because one of the things to look at here is that these are a lot of the markets where people migrated to.
Right.
So that's important, because now, for whatever reason, you now have these buyers markets.
Yeah, absolutely. And so before we get into where and what we recommend, let's look at mortgage rates, because mortgage rates are a big part of why the tides are starting to turn. Jerry, can you put up the picture of the guy with the quote? So the fate of the housing market in the coming months will be dictated in part by the direction of mortgage rates. So this is a mortgage rate issue in a lot of places. Now, the reason being is, we've seen the Fed continue to cut the interest rate, but the mortgage rates have continued to rise. So now you have high mortgage rates and high home prices, and there does come a point where people are always solving to their monthly payment, and both of those are going to affect it.
Well, the best example I always use is automobiles. So This is a long time ago when I bought my first car, but when I bought my first car, I could finance it 36 to 48 months.
Mm-hmm.
Or they even had a 24-month option. Okay. Now, again, why would I bring that up? Because I'm solving to my monthly. Then they went to 60 months. What that does is it lowers your monthly payment. Then they went to 72 months, lowers the monthly payment. Now they're at 84 months. So what they've done is doubled the length of time that you can finance a car. So that's what we're talking about by monthly payment. It doesn't necessarily mean that the cars went down in price or stayed the same. What it means is that the car prices went up and they just financed it out. And so that's what we're talking about when we're talking about a monthly payment. That is also on the table. They're looking at potentially making mortgages 40 years.
Yeah.
That would definitely lower the payment.
And up it. The house prices.
Correct. It could up the house price. So you take $407,000, which is what the number is today, and it's 30 years. If they make it 40 years, it lowers the monthly payment. That means more people can afford a house. So the other thing that article said is that we have an affordability problem.
Yep.
So that if houses are still going up nationally, then that means that you're still going to have an affordability problem. It's going to push more people into rentals.
Yep, absolutely. And I think a lot of people are confused as to why, if the Fed is lowering interest rates, mortgage prices are rising. And I wanted to pull up AJ Osborne's video for this because I think he explains it really well. And I think it's something that you need to understand. Instead of just waiting for the Fed, there's other things you need to look at that are going to dictate mortgage prices just as much as they do.
First of all, there's a big turning point in October. We already know the Fed lowered interest rates and they're going to continue, but the 30-year mortgage started to go up. It's because of how we get our 30-year mortgages. You see, in order to get the debt into the market, we have to sell bonds. Now, these are sold from the Treasury, and we have a 30-year Treasury. Now, if an investor buys a 30-year Treasury, they are going to get a 4.6% return. When everyone's worried, in order to get this debt, you have buyers and you have the government selling. Now, this is the key. Debt is a marketplace. And when everyone is really worried about the economy, they rush to find safe assets that will pay them a return. That way their money isn't worth less because of inflation. People run and they buy things like the 30-year Treasury. Now, when you have more demand, you actually have to pay them less. So rates go down because you have more buyers than you have Treasury bonds. So you don't have to pay as much because everybody wants them. It's the opposite, though, if everyone thinks that the economy is going to.
Okay, so I thought that was interesting because we get a lot of questions on that, right? So basically, it's a debt market.
Yep.
So they need people to invest in the debt market. So mortgage rates typically do follow the Fed rate eventually. But, as of right now, people are expecting the stock market to go up. They're expecting crypto to go up. They're expecting all these things to go up. So that then makes the mortgages more expensive.
Well, shout out to crypto. It's bouncing at 100 grand.
Yeah, exactly. Right.
So I know there's a lot of you guys out there. So, eventually, it's like a clock, right? Twice a day. But the reality is that it doesn't track perfectly.
It doesn't track
the federal
perfectly.
funds rate and what the Fed does. There's a lag, and I think that's important. Just like with inflation, there's a lag. There's a lag going down. There's a lag going up. And when interest rates are increased or reduced, there's a lag. And so they say, if you Google this, that it could be 6 months to a year before you actually see the results of the lag of some kind of policy or some kind of change.
Yeah. And what we're seeing right now with a lot of investors is that at these interest rates, things aren't cash flowing, right? So they're kind of sitting on the sidelines waiting for either prices or rates to go down so that it cash flows. And then we're seeing this with home buyers too, because they're trying to solve to their monthly payment. and the interest rates are making that a little bit expensive for what they want to buy. And everyone's kind of watching the Fed rate and kind of in this watch and wait game. So because they're kind of trying to figure out, okay, Trump's taking office. How is that going to affect home prices? How is that going to affect interest rates? They're kind of just waiting. And a lot of people are waiting, which is kind of why you're seeing some stagnation in the real estate market.
There's another psychological effect that's going on right now, and we'll just kind of pick on Florida. And I know Danille has a lot of research around this. If you have $200,000 or $300,000 in equity in something, and your neighbors, and you start to see price reductions in your neighborhood, you might get off the couch and say, you know what, I'm going to list. I'm going to list now before the knife is falling. You want to list before it hits the floor. So, that could be what's happening. I think, we're starting to see in some markets, it's not meaning we're having a crash, where people are panicking a little bit, and we're starting to see an inordinate amount of listings being listed in certain submarkets, right?
Right.
Which is having a cyclical effect. So it could be said that there is on the beginnings of potentially a mini crash in some of these mini submarkets based on amount of listings hitting, because what we were looking at this weekend was shocking.
But let's look at why there was. I agree with you that when your neighbor lists and then they have to discount, then you panic. But the question is why are so many people listing in Florida and parts of Texas? And if you look, what they both have in common is they've both had very significant insurance increases in the last few months with, and everyone's getting their new premiums for next year. And especially in Florida, they're going to be significantly higher. And they both are having natural disaster issues. Texas with the freezes predominantly, and Florida obviously with the hurricanes. And you can't discount that because, right now, a $350,000 house in not necessarily on the coast in Florida, just in a coastal area, meaning whatever they deem is close enough to the coast, their insurance costs are looking about $12,000 a year next year.
Yeah, so let's just, before we jump over that, because we were talking about this weekend, think about this. You're at a $350,000 home, which is a modest home.
Yeah, 3-bed, 2-bath.
3-bed, 2-bath, not on the coast. Your insurance is $1,000 a month. That's significant. So even if you didn't have any damage and you weren't on the coast, the insurance is subsidizing the state to pay for your neighbors, essentially, right? Regardless if you had damage or not. So these are financial decisions that people are having to make. And not only in Florida, we're seeing it in Texas as well, which, of course, a lot of it is along the Gulf. I've actually personally been through a hurricane down there in an area called Baytown, which is just a little bit south of Houston. And it was horrible. But what happens is the whole town gets wrecked, and then it goes under repair, and then your insurance costs go up. So we're actually looking as a company, do we want to divest from Texas as a company? And if we do, where do we want to deploy that money? And there's lenders and there's investors that are looking at this exact thing. In fact, when we were looking at our acquisition targets for in 2022, 2023, we started to look at the insurance costs for multifamily for Florida, and we said, let's pass, because at the time, insurance costs for multifamily were nearly $2,000 a unit a year.
Well, but okay, so that's multifamily. But then if you're the single family investor or a homeowner and you're saying, okay, so now my insurance costs are $12,000. There's also a real consideration that my home could be damaged by the hurricane. My insurance isn't even as good as it used to be. So I'm going to have to come out of pocket for a lot of that damage on top of this $12,000 a year if something were to happen. And, for somebody like me, like a small investor or a homeowner, like that's substantial. I mean, if I have to come out of pocket, like let's say I can cover the 12 grand with the cash flow, but if I have to come out of pocket, if I have major damage, then like that erases my cash flow for years, you know?
Yep.
And then I look at places like Arizona or other places that have very little natural disasters. And I'm like, wow, that's a much safer market for me. Even if I'm getting a little less cash flow, I'm also not having to worry about these big ticket items. And so if everyone's kind of collectively thinking like that, and we just had these hurricanes that hit Florida, of course people are going to start listing. And then of course, to your point, you see your neighbor had to discount your house, and you're sitting there like, well, we were debating and now we have to sell it before we lose our equity. And that's exactly what's happening right now in places like Tampa, Jacksonville, Orlando. Just this alone is making people panic sell.
And imagine if you're a realtor there. Let's say you're a realtor in Tampa.
Mm-hmm.
And you're now, one of the things that a homeowner looks at themselves, again, back to this car scenario and your monthly payment. They're looking at now buying a home, but they're also looking at their property tax and their insurance and their mortgage. So the mortgage costs are X, but now this insurance cost is starting to determine and even be a detriment for people that might even be entering the market.
Absolutely. And let's pull up, we have a realtor from the Todd Sachs podcast that was just on, and he's in the Orlando, Jacksonville area. And I thought what he had to say was really interesting.
Home inventory explode the most.
Yeah, well, like I said, in general, over the state, we're up. But right now, inventory for us, Jacksonville has blown up. Orlando has just blown up in the last week. You're talking, right now, I'll give you an example. You're talking the inventory right now in Miami's up about 12% down there. Jacksonville about 18%, and Tampa is about 7.5%. Tampa's still a
And
little
what
tight.
is this over what? Year over year or in the last 30 days?
Year over year. What's scary though is in the last 7 days, okay, just in the stellar MLS, 11,389 new listings in the last 7 days. You had price decreases, 11,997, almost 12,000. Now, the big number is back on the market. These are deals that fell apart. Contracts broke up, for some reason they canceled. 2,862.
Inventory exploding. What would you say is the number one reason homeowners are selling right now?
Well, the reason they're selling is they're trying, from my experience of all the listings we have, the sellers are trying to get out before they lose the equity.
Well, there you have it.
Yeah.
Directly from somebody who's in the market.
Exactly. 11,000 listings this is just the middle of Florida. This is not the whole state. 11,000 listings in the last 7 days. And like he said, they're trying to scoop their equity. They're starting to panic. They're going to lose their equity. And in fact, we, my family, we rent from a guy, he does Airbnb. And
in Destin, right?
In Orlando.
And
he has listed his home for 700 and some thousand. It's already down to 500 and some thousand. It's been on the market for a couple months, and he is letting us know he's trying to get rid of this. And what I was telling Ken, and we're really big on this channel with this kind of thing, is it's an Airbnb only neighborhood. You're not allowed to do long-term rentals. You can only do short-term rentals. And so there are 15 listings just in his neighborhood of probably 60 houses or something.
So that's not good. Obviously, you guys, as we always have said, you completely take out the fact that you could just rent it to somebody. It can only be an Airbnb in this Airbnb community. Now, it's close to, I remember, to Disney World.
Yeah.
And, which is kind of and by the way, there's other houses being built down there in that little submarket. We started to take a look, and that little submarket is I guess technically crashing, because you can't go from over 700 to in the fives and not consider that a massive price adjustment. And by the way, it's not going to sell at that price, because when we looked at it this weekend, there was a lot of them at that number, and they all look the same. You go on Zillow, they all have the same insides, and the houses are the same. They're built around the same time. So this is not something that the product style varies significantly from block to block or even house to house.
But we are seeing inclinations that this is, a potential kind of crash situation, right? Like we're seeing people panic in that area. And this is what a crash kind of looks like. People start to list, they start to panic, they can't sell anything. They're having, he had said on there, we cut it out, but things right now are selling 10 to 15% below market value because people are wanting to offload.
He did say 18 in some areas and 20. And I think what's interesting is was it 12,000 new listings?
Yeah, 11,000 and some new listings in the last 7 days.
Okay, guys, I just want you to wrap your head around that. Think about how many houses were listed in 1 week. Mm-hmm. That's a lot. Now, could it be an anomaly? Of course. Could it continue? Of course. Who knows? But this is what we wanted to talk about today, because as you guys start to take a look at some of these individual markets, especially as we kind of move toward the end of the year, as it's the old, if somebody is listing their house and the price is decreasing and they're on the fence and they're sitting on a bunch of equity, my belief is that these people are going to try to list early, and that's probably what happened here. And all of a sudden the supply flooded, and when a supply floods like that, you're going to start to see price decreases.
I read this quote. It said, if you're going to panic first. Well,
that's certainly true with you.
Yeah, I will be the first one to panic. That is for sure true. But Jerry, can you bring up the Wolf Street article? Because this is going to dive more into the Florida market. So we were looking at the national market, which is up year over year. But now we want to dive into the Wolf Street article. No, but okay, so let's just talk about it. So the median listing price in September dropped to $437,251. So an active, I guess we don't have the chart, but active listings surged over 35% year over year in Florida. So we have a 35% increase in Florida year over year.
What are we looking for here, Jerry?
I don't know. I don't think we have it.
Okay.
So
sorry, guys.
So anyway, so that's just kind of, where we're at. We also were seeing that in New York City and Las Vegas, things are kind of up too. We don't have that chart, but I think that is kind of where we're at with the market. It's not national, it's local.
Yeah.
Nope. So let's dive into our... Jerry, stop pulling just random charts up, please. Okay, so let's dive into our Ask Ken questions. If you guys want to sign up for premium, just go to kenmcrory.com /.
Oh, by the way, happy birthday.
Thanks.
Daniille's birthday, guys. Give her a shout out here. Come on. We had a nice little party for her last week.
Yep, absolutely. So Anshit is asking, would you still be doing cash out refinance had there been no taxes on real estate and no depreciation? Is cash out refinance only done to avoid triggering a taxable event due to increasing cash flow?
Well, so I guess we need to back up a little bit. The point of doing a cash out refi always is to put whatever equity you have in something and pull it out and redeploy it. So that's number one. So people ask me all the time, should I sell? Should I refinance? Should I do this? Should I do that? And I always say, what are you going to do with the money? So that's the first thing. And so if you have a lot of equity, for example, then you can put a new debt on there and pull that out tax free. Now tax deferred, because how can that work? So the reason it works is because debt is not taxable. You pay tax when you sell. So if you're using new debt to replace old debt, and the difference is cash, it's no different than a home equity loan. If you put a home equity loan on your home and you pull that out and you buy a boat, then that's not necessarily good. If you pull it out and you do an addition to your house, that might make you a little bit more, but you're still paying on that, and you're basically increasing your debt. So you got to pay attention to, do you want to do that? Do you want to replace out an old an old interest rate, let's say lower, for a higher interest rate just to get access to capital? The answer might be no. So right now is not necessarily a refinance cash out time, because especially if you have something sitting there at 3-4%. Like Danille's got a condo that she owns. You're like 2.8, right? Mm-hmm. She's at 2.8, so she's locked. Her payment's low compared to the rates today, so she would be crazy to get rid of that, just to have a fair amount of equity in that.
Well, we also did the math on, my one condo that's paid off, and then versus my condo that I have a mortgage on. The cash on cash is actually better on the condo I have a mortgage on versus the one that's completely paid off.
Yeah.
Which was surprising to me when we did the math.
So how do you figure that out? So here's what you do. You take your equity and you say, if I have that, how can I put it to work somewhere else? And this is why leverage actually can make your returns better, believe it or not. So paying everything all cash isn't always the best scenario. So you have to look at it that way. And so you have to look at your, what will that rental do? What is your cash flow on that property? It's going to change if you put new debt on there and at a higher rate. It'll actually go down significantly. So it might not be the best scenario. And then, of course, is what are you going to do with the money? That's actually the biggest question. What are you going to do with the money? And if you don't have a spot for it that's going to make you more, then you're probably better off just keeping that low interest rate and having that equity and seeing what happens with rates. But if you're hedged and you're fixed and you're good, like Danille's scenario, there's no reason to trade that out, because she's making so much cash flow on that thing because she's got a 2.8% loan. And on one that she has no loan, she actually is not doing that great, because she's got hundreds of thousands of dollars sitting in this property with no debt, and it only makes, I don't know, $2,500 a month or something.
Yeah, a couple grand,
something like that. Mm-hmm. So you got to look at your return. So she makes $24,000 on, let's say, $300,000 of equity. Okay, that's a number.
Yeah.
What is that? So if she was making $24,000 on $100,000 of equity, and she was using that $100,000 for something else, that now she's doing it twice. And yes, the return's a little lower, but she's only got $100,000 of equity, and she's still making let's say, or $2,000, let's say, of cash flow.
Yep, absolutely. And Ken on YouTube doesn't really have a question, but he had a good comment, so I want you to dive into it. He said, "Do not improve your home with a cash out refi in a declining market. Keep the money on the sidelines."
He is right. That is right.
Mm-hmm.
You guys be careful, because a higher interest rate means higher payment and less cash flow typically. So those low interest loans, they're gold right now. They're actually, I would actually consider them an asset.
Yeah.
Because anyone would step into your shoes to have that low price money, and that's all it is. It's low price money. So if you can afford to, don't refinance that first.
Yeah, absolutely. And you kind of told me that too, because one of my condos needs quite a bit of work, and I was thinking about doing it, right? I was like, I'm going to rip the floor up. And you said, don't waste your money on that right now. Rent it for less, because rents are going down. So you don't want to, they're like neutral or softening. So you don't want to improve your place at the same time as rents are going down, right?
But also, there's another reason. But yeah, we did go through these scenarios on all hers. But the other reason is affordability. Mm-hmm. Like, if you put a bunch of money into something and you want more, you're going to want more money for it. If you aren't getting more money, then why would you do it?
Well, but that's a fair point, though, because I think somebody like me, you say that, and now my head's wrapped around that, right? But to me, I was like, I want to do this because the place isn't that nice. It's not going to be as easy to rent. So my whole strategy in my mind was I'm going to rip up the floor, do all this stuff so that it rents for the same exact amount, but that it rents, right? And then you're like, no, you need to be thinking of this from a more business aspect. So like if you're going to put $6,000 of work into a place, how much more is it going to cash flow? Because it doesn't make sense to put the money in to make the same amount of money.
Well, your return on investment investment is zero or negative.
Right.
If you do that, if you put $20,000 or $30,000 to completely renovate a place and you're not getting more money, then you've actually just taken money that's making money somewhere and put it into something that's actually net zero.
But what I had to wrap my head around, though, is that, okay, say it's $6,000 to redo my condo. If I actually have to rent it for a couple $100 less to get it filled, keeping it the same, it makes more sense to do that than to keep it neutral cash flow, or maybe like be able to increase it $50 or $100 and invest $6,000. Like, it really does come back to the math. And, you know, some of you listening are saying, okay, that's obvious. Others of you listening were like me, where you're just trying to make it nice so that it rents. And then you're not really looking at the numbers, and you really need to look at the numbers. And that's why I was so surprised when we sat down and looked at my numbers, and I realized I actually make a better return on
with a little bit of leverage.
with leverage, you know, because I wouldn't have thought that. Because obviously the one that doesn't have leverage makes more money, but not for the money that I have invested into it.
Not for the money you have tied up.
Right. Correct.
As far as equity. And so when we at one point had, this is a mind-boggling number, but we had $68 million worth of renovations going in our company. So that means we had hundreds of units being renovated, and we had thousands more that we were renovating. And this was the value-add strategy that everybody was so pumped up about. Well, when interest rates went up, and I said, let's pull back, because we started to see affordability problems with people. So I said, who cares if we have a 2-bedroom that rents for $2,000 and what we call a classic unit that rents for $1,500? Because now you've got two different markets. You got somebody that can't afford $2,000 and somebody that can't afford a $1,500, let's say, and it's just not renovated. So having non-renovated housing, by the way, there's nothing wrong with your place. It's just Danille wanted nicer floors.
Right.
There's nothing wrong with it. It's a great location in Scottsdale, and the thing's only 25 years old, maybe. So, but it's dated a little bit, but it doesn't need that kind of work. And so, why not offer an affordable option for somebody? Because it's going to be significantly less, and they'll be grateful. Not everything needs to be high-end renovated, because then you don't have any room for people that can't afford that.
Yeah, absolutely. And Edison on YouTube is asking, do you see this as a good time to buy, wholesale, and flip?
Well, it depends on the property,
Depends on the market, too.
Yeah, if you, as we like to say, you might be catching a falling knife if you're trying to do that in Florida. Like, it's way too early there. Like, this could be just a little blip, like before the year end, or it might be a trend. So it's too early to say.
That actually is. You brought up a good point on a question I know a lot of people have, even though they haven't asked. But is it a good time to buy in Florida? Because, things are getting discounted. People are starting to panic. Is this not a good time to buy? Because you always say you want to buy when no one wants to buy, and you don't want to buy when everyone wants to buy.
You got to pay attention to lag. Mm-hmm. The first thing that happened is they got listed. You have not seen the price reductions yet. That's the bottom line. Mm-hmm. Like, just listing something is the precursor. When we talk about dropping a pebble in the pond and the concentric rings, that's called precession. So what the pebble in the pond is the listing of 11,000 units. You have not yet seen, and you will, the precessional rings, in which are going to be price reductions for sure. So no, you don't want to be in Florida right now.
Well, and I had a question about that, though, because, what I'm seeing a lot right now is people kind of urgently jumping because they're hearing that prices are going down, or they are thinking they can get a good deal. And I think as a buyer, you really have to understand what your numbers and where it cash flows. And like I had a couple clients last weekend, and they wanted to make this lowball offer on this house, and that had been sitting, and I said, okay, but be careful making that offer because you might actually get it. Like, you know what I mean? I think people are kind of like in this stage where they want it so bad and they've been waiting so long that they're ready to buy anything that they feel like they can get a deal on. And in certain markets like Florida, it's time to just chill out for a second.
Yeah.
Just like let it all kind of play out.
Days on market is important, guys. And, you know, it's going to take a while, right? What's normal? 6 months. That's traditionally normal. That's average, 6 months. So right now it's 4.2. So all that's happening is the craziness that we experienced and the bubble that was created is deflating a little bit right now. Again, not nationally and not everywhere as we showed on that heat map.
Yeah, and everyone's saying, you know, patience. Like Moses just posted something interesting. He said in the Orlando area, new listings were 1,200. Sold 600, price decreased 1,400. So these are kind of some of the numbers that you want to pay attention to and continue to pay attention to as you're looking as to when to buy.
Yeah, so if you're a realtor down there, this should actually be good news for you. I mean, it might seem the opposite of that, but if you have clients that want to come into Florida, the right advice would be, let's see where this goes, because if you're really trying to do the right thing for the buyer, you're trying to have them understand that pricing could be adjusted downward in some of those markets, and you might want to tell them to wait. And that's actually what you should be doing if you're investing there too. Is you should be waiting. These are again, this is one small market.
I do have a question though.
Yeah.
So, you know, it's hard to gauge, but with insurance costs, this is kind of a interest. So, you know, I'm a buyer, I'm an investor, I want to buy in Florida. Even with the, you know, insurance cost in 2025, my property is going to cash flow. I'm happy. How do I really, though, know that it's not going to explode again, the insurance prices in 2026 and 2027?
We don't.
And that's what makes it harder, right?
Yeah. Yeah. I mean, obviously, you know, I believe the next low-hanging fruit is going to be property tax. Taxes are a big piece. And so, you know, insurance is, you know, who knows? Insurance is up for sure. But property taxes are kind of next. We're starting to see utility costs up as well. Not everywhere, but certainly there. And then labor costs and, you know, everything it costs to maintain, they're all up. What's not up? Rents.
Right. So how does an investor, though, look at that? I mean, you know, because I know everyone's like me on the sidelines, like, well, how do you know?
This is the best time ever.
How does MC Company kind of gauge it?
It's the best time ever, guys. Like, there's nothing more frustrated to me than sitting across from some 20 to 30-year-old kid and they say, you know what, last year was 6 or 8% rent growth. The year before, 6 or 8% rent growth. Next year is going to be 6 or 8% rent growth. Guess what? That's not happening right now. So, and the reason is they haven't been through any cycles. And so if you're looking in the rearview mirror and saying next year is going to be better, then you probably need to take a break because it's not. What's happening is prices are flat, rents are flat. Obviously, we just saw the single-family home prices are actually not. But in the rental market, things are flat right now.
Yep, absolutely.
Affordability is a real problem.
All right. Well, you guys have a good Thanksgiving, and we will see you next week.
Cheers, guys.